The biggest macroeconomic items in the coming week are regular features in this podcast, namely the latest UK unemployment and wage growth numbers on Tuesday the 17th of August, and then an update on inflation from the Office for National Statistics on Wednesday the 18th. To start with the jobs numbers, the unemployment rate in the 3 months to May was 4.8%, down from 5% in the prior period. The employment rate was 74.8%, and perhaps most encouragingly, the number of job vacancies was 862,000, higher than it had been before the pandemic struck in March 2020. Attention will then switch to wages. After all, if job vacancies are surging and firms are having to compete to attract and retain talent, then that could see workers get better terms and conditions. In May, wages surged 7.3% year on year, including bonuses. Now, part of that's a base effect. Part of it's because at the moment some of the people who are losing their jobs are the least well paid in the economy, such as gig economy workers. But some of it could be the result of staff shortages. The day after the jobs numbers, we'll get the inflation data. The good news is that for the average worker, average pay is easily outpacing inflation, meaning they're better off in real terms. Even if that won't be the case for everybody, especially those who are still on furlough or those who have been unlucky enough to lose their job. Nevertheless, that trend could still be good for consumer confidence, consumer spending, and thus the wider economy, although central bankers will be on alert for sustained increases in pay, as that can help to entrench inflation, and the usual response to that is tighter monetary policy in the form of higher interest rates. In June, inflation based on the Consumer Price Index was 2.5% year on year, above the Bank of England's 2% target and the highest figure since summer 2018. On the corporate front, there's a select slate of announcements due, although it should be no less informative or interesting for that. Please note that some of these dates could still be subject to change. On Tuesday the 17th, we have JustEatTakeaway.com and Plus 500, Persimmon, Network International, Balfour Beatty and Hochschild Mining on the 18th, Antofagasta, South 32, OSB, Marshalls and Rank on the 19th, and then building materials firm Kingspan will round out the week on Friday the 20th of August. But the company which could just cause the biggest fuss in the week ahead is BHP. The mining giant's due to report its full year results at the end of June on Tuesday the 17th of August. BHP shares are pretty much trading at an all-time high, helped by hopes for a post-pandemic economic recovery, commodity price strength, and the company's own capital discipline and self-help programs, which have seen successive management teams rein in capital investment, rein in acquisitions, sell assets, and pay down debt. Remember that BHP has 6 main product areas. They're iron ore, copper, petroleum, coal, nickel, and potash. The profit mix on the basis of adjusted operating profit from the first half of the company's fiscal year is shown here. Iron ore and copper are the materials that really count, and they're the commodity prices you need to track if you're researching BHP above all others. BHP's trading update in July outlined production volumes for the year just gone and also offered guidance for fiscal 2022. In 2021, petroleum beat expectations, energy coal missed, and the rest met. For 2022, copper, nickel, iron ore, metallurgical coal and petroleum could all show output growth, while thermal coal will show a clear decline. In terms of the headline numbers, the analyst consensus forecasts are as follows. Sales are $59 billion against $43 billion a year ago, and analysts are looking for $63 billion in the fiscal year just begun. A near doubling of statutory or stated operating profit to $30 billion, with a further increase to $35 billion in 2022. A doubling of earnings per share, or EPS, to $3.15, with a further one-third advance in the coming year to $4.41. And a dividend of $2.89 against $1.20 a year ago, with a further increment to $3.34 expected in the coming year. That means BHP is expected to show the greatest dividend growth in sterling terms of any firm in the FTSE 100 between 2020 and 2022, and it's enough to put the stock on a double-digit forward dividend yield. Analysts will also watch out for any comments on share buybacks. Now, the question then is whether these dividends can last or not, and analysts don't seem convinced. They've got sales, profits, earnings per share, and dividends all falling in the year to June 2023, which is in keeping with central banks' view that current price inflation is transitory, the result of a post-lockdown surge in demand, production bottlenecks, and shipping shortages. If we do get a really inflationary recovery, though, those forecasts could still prove conservative, but only you can decide for yourselves which scenario you believe will pan out. Two final numbers to watch are capital expenditure and net debt. Net debt ended the first half $11.8 billion, the very bottom of the company's $12 billion to $17 billion target range. CapEx was forecast to be $7.3 billion in fiscal 2021, and the last published budget for 2022 was $8.5 billion. Analysts and investors will be watching for signs that capital discipline is being maintained, or not. Remember that BHP has just launched a cash bid for Canadian nickel miner Noront. Shareholders will also seek updates on major new projects such as the Ruby oil and gas find in the Caribbean, the Atlantis oil field in the Gulf of Mexico, Australia's South Flank copper mine, the Jansen potash project in Canada, and the option to ramp up and expand the Spence copper mine in Chile. As a final point, BHP's already sold its US shale oil and gas assets. Media reports suggest the whole oil and gas business may now be up for review, while BHP is also looking to exit its thermal coal business, the value of which it wrote down by $1.6 billion in the first half of the financial year just ended. Boss Mike Henry said the process to shed the thermal coal business could take 2 years, and that a sale or demerger were both possibilities. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.